In today's video, I'll tell you why taking loans and paying interest on it is not necessarily bad and in many cases can actually be good for our finances. While there is a lot of financial advice out there telling you that you should pay off all your loans before you start doing anything else, we're gonna tell you otherwise. Let me tell you why. Cha-ching! Before we start, it's important to distinguish the two types of loans, being a flat rate loan and a reducing balance loan. Let's say I want to take out a loan of 100,000 ringgit for 2 years at an interest rate of 10%. A flat rate loan would take the 100,000, multiply it by 10%, meaning the interest that I'll be paying every year would be 10,000 ringgit. In the second year, I will also pay the same 10,000 ringgit as its name, a flat rate loan. Every single year that I have to pay back this loan, I will be charged the same interest amount of 10%. So for this case, I'll pay 10,000 ringgit in interest in the first year, and in the second year, meaning in total, I'll pay 20,000 ringgit in interest. On the other hand, reducing balance loans work as your namesake. In the same example, I'll pay 10% of 100,000 ringgit in the first year, being 10,000 ringgit. However, of course, our installments also go partially to paying down the principal of 100,000 ringgit. So let's say after the first year, we've paid off 10,000 of this, meaning we have 90,000 ringgit left of our loan. In the second year, it will only charge us 10% of the 90,000 ringgit, meaning an interest of 9,000 ringgit. In total, over the 2 years, I'll pay 19,000 ringgit in interest versus 20,000 ringgit on the flat rate loan. This means that reducing balance loans are always more favorable to consumers. In that case, we should always just take it, right? Well, we don't really get to choose. Personal and vehicle loans are usually flat rate loans and no bank will give you reducing balance ones, while stuff like a housing or an ASB financing loan will usually be reducing balance and it won't charge you a flat rate loan. Now, let's go on to why taking out some of these loans can actually be good for your finances. The idea for this video popped up because when Proton launched their all-new X50 model, I've been super tempted to get one for myself. And I was considering how much of a down payment should I put. Should I put 10%? Should I put 0% like a lot of these car companies are proposing nowadays? Or should I just put as much as I can? If I just followed standard personal finance advice that we always hear all the time, I would put as much money as I can into the down payment, or in some even more extreme cases, people will tell you should pay off the whole car in cash. Well, I disagree. You see, there's this very important concept in personal finance and I think in life in general that a lot of people don't really understand, being opportunity cost. It's something that I learned from economics class in university, which basically means what is the cost of doing something over another. To illustrate this, let's say I decide to cut my own grass instead of hiring a gardener to do it, which will definitely save me some money, right? But the thing is, I would actually be foregoing time that I could have put into a YouTube channel to generate more income for myself. In this case, is it really worth skipping out on paying the gardener to do that work while I use the same amount of time to build this YouTube channel? You see, time is a finite resource, and just like a lot of other things like our money, they're all finite resources, which means whenever we use our resources, we're actually foregoing something else. If I go to Baskin-Robbins and choose chocolate flavored ice cream, which by the way is the best one, I'm foregoing the 31 or whatever amount of other flavors that they have. Similar to the two other examples that I just mentioned, the opportunity cost of paying for my car in full with cash is that I'm missing out on the chance to put my money into investments instead that could potentially give me more returns. Will putting my money in investments benefit me more than saving on the interest by paying for the car in cash? The short answer to that, yes it will.
What? How can you pay interest to the bank and be better off? That makes no sense at all.
Paying interest is not a bad thing, guys. A lot of people seem to have this conception. The key, which I think is the most important part here, is that the interest that I'm paying to the bank is actually less than the amount of returns I'm generating from my investments. Bank Negara and central banks all over the world has reduced interest rates by so much that I can get a 9-year loan on a car for less than 2.5% per year. If we take the average 7% return on investment, there is a 4.5% spread, where basically I'm making more money from my investments than I'm paying in interest to the bank. Do note, however, that the 7% is not guaranteed and it really depends on how the market performs. However, Malaysians can opt for ASB, so whether it's ASB 1, 2 or 3, where the returns will most definitely be higher than the 2.5% mark. This then of course doesn't work for super high interest loans like maybe personal loans or credit card debt, where the interest rates can go up to 18%. Unless you can really generate investment returns of higher than 18% a year, which I highly doubt many of us can, then you better off pay off that loans. So, how can you execute this into practice? Let's say you have money saved up to buy a 50,000 ringgit Myvi. Instead of paying the 50,000 ringgit to Perodua in cash, what you should do is you should take out the loan and put this 50,000 ringgit into your ASB account. Withdraw your money as you need. So let's say every month or every 3 or 6 months, and take out this money that you need to pay for the installments. While the 50k is in there, it's actually generating you returns which should be higher than 5% per year. I'm not giving you the full calculations for this, but at the end of the day, I can almost guarantee you that you'll be better off taking this and putting it into ASB than paying for the cash upfront. If anyone else thinks otherwise, let us know down in the comments below. I'm always happy to debate on this. Even if you don't have the cash to pay for the car upfront, the concept still works the same. Reduce the amount of monthly payment that you can by as much as possible, meaning extending your loan from 5 years to 7 years or 7 years to 9 years if you can. Let's say you have 700 ringgit a month that you've put aside to pay off this car. If you take a 7-year loan, your monthly installment is 700 ringgit. So you think, perfect, right? I have 700 a month, the car is 700 a month, I'll just take the 7-year loan option. Well, no. You should go for the 9-year loan option, which let's say costs 600 ringgit a month instead. When you do this, you still have to commit to paying 700 ringgit a month, but instead of paying it all to the bank, you're paying 600 ringgit to the bank, where the remaining 100 will be put into your ASB account. Even though you'll end up paying more interest to the bank with a 9-year option compared to a 7-year one, I'll guarantee you that if you take the balance and put it into ASB, you'll be better off. This rule only works, of course, if you're really financially disciplined and take the difference in installment between the 7-year and 9-year option and put it into an investment. If you don't, and you just take the extra 100 ringgit that you've saved by extending your loan and go out and buy something, then of course you'll be worse off in the end. So, financial discipline is super important for this to work out, and if you don't think that you can do it, then by all means I 100% advise you to go for the shortest loan tenure. On a related note, this also works for EPP, or Easy Payment Plan, for smaller purchase items like your iPhone or an Apple Watch. I actually bought both my Apple Watch and AirPods on installment instead of paying for it outright. It's not because I was irresponsible and couldn't afford these gadgets, but it's because the interest rates on these easy payment plans are actually 0%. You see, when you're presented with a loan of 0%, and as long as you're not in a European country or Japan where the interest rates are negative, you should always take it. I mean, why wouldn't you? I took the 900 ringgit, which is the cost of my AirPods, and put it into my ASB account, and I bought it on loan. Every month, I will just withdraw from my ASB account and pay off the bank, and at the end of the 6 months that I took the loan for, I'll actually be better off because my money is generating returns in my ASB account. Even if you can't do it on ASB, you can always put it in something like Stashaway Simple, which gives you 2.4% interest when you're paying 0% interest on your loan, right? Of course, this isn't a good idea if you're only taking the loan to buy the latest iPhone 12 because you can't afford to pay for it in cash. The basic personal finance rules of living within your means and not buying things that you cannot afford still applies. This is more for those of you who can already afford it and you have no issues buying it. Well, I think you should really consider taking up a 0% interest loan instead of paying for it in cash. How about paying off loans? Does it work the same? Well, yes it does. There's a lot of financial advice out there telling you to pay off your loans as fast as you can and for that to be your number one personal finance goal. If the interest rate of your loan is low, I would honestly say that that is just wrong personal finance advice. I mean, if the loans are extremely high in interest rate, like I mentioned, if you have 5,000 ringgit to pay off your credit card debt charging you 18% annually, then of course, by all means, pay it off. However, stuff like PTPTN loans, car loans, and ASB financing have very, very low interest rates, especially in the current environment, that you should really utilize. Let's say I've saved up 30,000 ringgit, which is the exact amount of my PTPTN loan. I can either pay off this loan immediately, which only has a 1% interest rate annually, or I can take this money and invest it and get 5 to 6% every single year. Yes, I would still have to pay for the PTPTN installments monthly, but the income that I'm generating from my investments actually far outweighs the amount of interest that I have to pay. I hope it makes it more straightforward for you to compare when I put it like this. The opportunity cost of paying off your low interest loans faster than you actually need is the fact that you're missing out on the potential of gaining some very nice returns on investing that cash instead. With everything being said and done, I just want to say that I realized things aren't always that simple. I know that things just don't always work perfectly. Some people just don't like the feeling of being in debt, and that's completely fine. I mean, I get it. You just want to feel free and not have to think about paying your installments every single month. I'm just trying to paint a different side of the story for you to show you that it can sometimes be good to actually have some loans. At the end of the day, it's your decision to make. All we're trying to do is just providing you the necessary information to help you in making that decision. If you guys like this video, give us a thumbs up, and if you haven't subscribed to our channel already, click on the subscribe button right now.